Welcome to Wall Street's Dirty Secret, how they fake stock market returns. Welcome everyone. We're going to pull back the curtain and reveal what Wall Street does not want you to know. And I promise to give you a very different perspective of stock investing. You will learn how Wall Street, using what I like to call Wall Street math, misleads stock investors into thinking that the stock market has provided high historical returns, when in fact, the stock market rarely provides high returns in periods of 20, 25 years or more, which leads to retirement planning failure for most stock investors. Are you ready to uncover the truth? For years, Wall Street has been selling us a story about high stock market returns that does not match up with reality. So this is the bull of Wall Street, and everyone that has money in the stock market hopes for a bull market. We have all heard it. The stock market averages 10% over time. But here's the thing, average return is a market return, not a true measure of what stock investors actually receive. We are going to break down Wall Street math and show you the reality of fluctuating investments like stocks and expose how these so-called average returns could be devastating to investors' long-term wealth. Welcome to Wall Street Math. And I promise to give you a very different perspective on stock investing. Let's review what you will learn, how Wall Street, using Wall Street math, invented a misleading measure of return called average return that does not reflect the actual returns of the stock market in order to create high historical stock market returns of 10% or more that do not really exist. How before and after every good stock market period, there is a bad stock market period, which is one of the many reasons why most stock investors fail to accomplish their retirement planning goals. How the stock market actually performed for 10, 25, and 60-year periods. What a $300,000 rental property would be projected to be worth in 25, 30, or more years using Wall Street math. How to request our free booklet entitled The 10 Main Reasons Why Most Stock Investors Fail When Saving for Retirement. This information could change your financial future. Before we get started, I'd like to give you some information about myself. I first became a realtor in 1979. I also became a stockbroker 40 plus years ago and a certified financial planner 35 plus years ago. I am a real estate investment advisor, creator of the Wealth Agent Institute, the Ultimate Agent Training, and the Wealth Agent Certification Program. We've all heard that the stock market has historically averaged around 9%, 10%, or more. Let me show you what a $300,000 stock account would be worth if it increased at a 10% compound rate. Look at what it would be worth after 25 years. Unfortunately for stock investors, the stock market rarely provides high returns of 10% or more. But Wall Street wants stock investors to believe that the stock market has historically provided returns of 10% or more, which simply is not true. Do you believe that a $300,000 stock account will increase to $5.25 million in 30 years, or over $13.5 million after 40 years, or $35 million after 50 years. Here is a quick look at the last 120 years. Before and after every good stock market period, there's a bad stock market period. If you take where the stock market was at the beginning and end of each decade, you can calculate the exact compound growth rate. Do you see in dark green that the stock market only had 4 decades of good stock market returns of 10% or more? The math does not lie. Let's look at another period. Here we have 11 different 25-year periods going back to 1900. Please look at the column in yellow on the right-hand side. These are the actual or real compound annual growth rates of the stock market. In red are the bad stock market periods with returns of less than 5.5%. If you take where the stock market began and ended for each period, you can calculate the exact compound annual growth rate or real return for the 11 different 25-year periods. Historically, investing in the stock market, the Dow, the S&P 500, and others has provided much lower actual compound returns than most stock investors think. Look at these low growth rates, 2.33%, 0.25%, 1% and change, about 2%, 7.25%, 4.75%, a little over 2%, 6.5%, one good period of over 10%, 7.2%, and less than 5.5%. These are not very impressive. For the most recent 25-year period, the stock market only provided a compound growth rate of 5.41%. If the actual rate of inflation was more than 5% and the stock market only increased by 5.41%, there was no real increase in purchasing power of a stock account after 25 years. And you see, there was only 1 out of 11 25-year period with compound growth of more than 7.67% or 7.2% since 1900. It is important for you to see that the stock market does not provide high historical compound returns of 10% or more most of the time. Let's look at it another way. Here are the 60-year periods from 1900 to 2020. Please look at the column in yellow. For the last 60 years, the stock market only increased at a low 6.45%. Not that impressive. Would you agree that it's fair to say that the stock market rarely provides high stock market returns? If you're a stock investor, it's my hope after you finish this module that you will question the way you're saving and investing for retirement, because your financial future could depend on it. Take a look when you Google, what is the average return of the stock market? You can see in these Google searches, it lists that the stock market averages 10% or more. What is average return? Average return is adding up all the annual returns and dividing by the number of years. This is a simple average number. It does not represent a real return. Average return is not a real return. Now we'll show you how they come up with average return, or as we call it, Wall Street math. Is a 25% average return for a 2-year period a good return? The answer is no. Let's have some fun here. Let's show people the Wall Street math. Let's show how they create high average returns. You can use Benjamins. I chose Benjamins here because I think it's kind of fun, or $1 bills. And the $1 bill or the Benjamin will represent a $100,000 stock portfolio. If it increases in the first year 100%, goes from $100,000 to $200,000, and in the second year it decreases only 50%, it'll go from $200,000 back to $100,000. How much do you have? You have $100,000. It started at $100,000 and ended at $100,000. That's the concept. The real return was 0, but the average return was 25% for this 2-year period. Wall Street math. Using Wall Street math, the average return of 100% increase plus a decrease of 50% divided by 2 years equals an average return of 25%. Now you and I know that if your stock account started at $100,000 and then went up to $200,000 and then went back down to $100,000, you had no return. But if you use Wall Street math or average return, your average return was 25%. This is how Wall Street can create high historic returns that do not really exist. Here's another example of Wall Street math. They can create a 10% average return by adding the 100% increase plus a decrease of 50% with no increase for the next 3 years, divided by 5 years equals an average return of 10%. If we take the percentage number of 50% and divide it by the 5-year period, you get 10%. This is how they come up with an average return of 10%. This is what we call Wall Street math. Here, using Wall Street math, the average return was 10% when the real return was only 0. How does Wall Street create an even higher average return? They count 100% of the dividend income. Here we have 97 years of annual stock market returns. And you can see the average return for this 97 years is 11.38%. But the real return, or the compound growth rate, is only 5.66%. Using Wall Street math, if you add up all the annual returns and divide by the number of years, they can create an 11.39% average return when the stock market had a loss for this 10-year period. Here's another period. Do you see how Wall Street can create high average returns for any period when the real compound return is much lower? We have a free booklet that explains the 10 main reasons why most stock investors fail when saving for retirement. If you would like a free copy of this booklet, please click the link below. It could change you and your family's financial future. So what do you think about Wall Street, the financial services industry, and the insurance industry using Wall Street math to create high stock market returns that do not really exist? Here, the blue column shows the actual 25-year returns since 1930. You can see they are not that impressive. Now let's compare the real stock market compound returns in the blue column versus the average returns in the yellow column using Wall Street math. Do you see why using an average return can be misleading to anyone who invests in the stock market? Look at these high, fake 25-year average returns. About 11.5%, almost 13%, over 11%, almost 9%, almost 13%, about 14.5%, over 10.5%, and 8.58% for the most recent 25-year period. Since 1900, the stock market has had 125-year periods. Guess how many 25-year periods had compound returns of more than 10%? There were only 7 out of 100 25-year periods with compound returns of more than 10%. And because of bad stock market periods, there's never been a 30-year period or longer with compound returns of more than 10% since 1896. Anyone that puts their money in the stock market when planning for retirement should request our free booklet. Please click the link below. Now let's have some fun. Let's see what happens when we apply Wall Street math or average return to real estate. As real estate professionals, we would never do this, but it's a great way to show how Wall Street comes up with these high projected future portfolio values. Here we have a $300,000 rental property. In this hypothetical example of a local market, let's say the real estate has historically increased at a 5% rate. Let's assume the rental income from this property is 5%. If we use Wall Street math and apply it to real estate, and the annual increase of real estate value is 5%, and the annual net rental income is 5%, we can create a 10% average return. Let's assume we use that made-up average return percentage rate of 10% as a compound annual growth rate when projecting the future value of this rental property after 25 years. And after 25 years, take a guess what this rental property would be worth if we use Wall Street math. It would be worth $3,250,412. If you look at this illustration, you can see if we use the same methodology of average return and applied it to real estate, just how inflated these numbers would be. Now, do you believe that a $300,000 rental property or a $300,000 stock account will increase to $5.25 million after 30 years, or over $13.5 million after 40 years, and over $35 million after 50 years? Average return does not equal compound interest or compound growth. Unfortunately, many stock investors and financial advisors confuse average return with compound interest and compound growth. So you now know what it means when they report high historical stock market average returns in the news, on the TV, or anywhere else. It's not what stock investors actually end up with. And you also know that before and after every good stock market period, there is a bad stock market period. Just as a forewarning, the stock market is overdue for a major correction because history tends to repeat itself. This free booklet entitled The 10 Main Reasons Why Most Stock Investors Fail When Saving for Retirement will be eye-opening as to the risks of investing in the stock market for retirement. please click the link below for the free booklet to learn why investing in the stock market may not work out for your retirement. If you're a real estate agent ready to level up your business, boost your income, and stand out as a true professional, it's time to become a certified wealth agent. Take our certified wealth agent training and get your new designation at wealthagent.com and become part of a movement of elite professionals showing clients how to retire early with less money invested. Don't just sell real estate, transform lives and dominate your market. If you would like to find out how to retire early with less money invested through real estate, or would like a second opinion on your current retirement plan, we're here to help. Visit wealthagent.com to schedule your complimentary consultation today. Dream bigger, retire sooner. Your new path begins now. Please go to wealthagent.com to learn more. And thank you for watching. I'll see you in the next video.